You sell wholesale, collect no sales tax, and figure an audit can't touch you. But auditors ask for one document first, and if it's missing, every exempt sale gets taxed, even though those sales really were exempt. Our team sees this pattern constantly, so today I'm walking you through what this document does, what makes one valid, and the deadline most sellers don't know exists. Here's why one piece of paper carries so much weight. An exemption certificate isn't a receipt. It's a transfer of liability. Sales tax is built to apply one time at the final retail sale. Exemptions exist to stop the same dollar being taxed repeatedly as goods move down the supply chain. When a buyer hands over a valid certificate, they're taking on responsibility for the tax treatment of that transaction, and the seller, having accepted it in good faith, is protected during an audit. Without it, that protection doesn't exist. The liability stays where it was, with the seller. So the certificate isn't documentation of the exempt sale, it's the thing that makes the sale exempt as far as the state is concerned. Which raises the obvious question, what makes one valid? A certificate is valid when it's complete and when it was accepted in good faith. Complete means the specifics are filled in. The date, both business names, the buyer's business ID, a description of what's being purchased, and the stated reason for the exemption. It also has to be signed and dated, and an unsigned certificate is an incomplete one, and incomplete is considered the same as missing when an auditor is looking at it. Considering the type of exemption is important when validating. Generally, exemptions come in three types: resale, buying inventory to sell on; use-based, manufacturing equipment, agricultural inputs, materials consumed in production; entity-based, government agencies, schools, qualifying nonprofits, exempt by who they are rather than what they're buying. Good faith is the last piece. The seller is expected to have verified that the certificate looks right and applies to what was actually sold. A certificate that doesn't match the transaction is not much better than no certificate at all, and these get retained, generally 3 to 7 years depending on the state. Now for the part that turns a paperwork problem into a deadline. When an auditor finds exempt sales with no certificates behind them, that isn't automatically an assessment. States generally allow the seller a window after written notice to go back to those customers and obtain them. But it's a hard window, measured from the date of that notice, typically 30 to 90 days depending on the state. New York allows 90, but Texas issues what's known as a 60-day letter, and Texas is the one worth understanding because it's strict at both ends. The 60-day period does not extend. A fixed statutory deadline isn't the kind that gets negotiated, and certificates handed over after the exit conference may not be credited at all, no matter what they say. Miss the window and a valid exemption becomes an assessment permanently. That said, there is a ratio that often comes up during an audit, which is the exempt sales percentage ratio. Why does this come up so often? Because the businesses most likely to have gaps in their certificates are the same ones states are most likely looking at. States compare a business's exempt sales percentage against industry norms. A general retailer reporting 10 to 15% exempt sales looks ordinary. A general retailer reporting 60% does not, and that gap is one of the more reliable audit triggers there is. That's the uncomfortable structure of it. Businesses with a genuinely high exempt ratio, such as a wholesaler, a distributor, or a manufacturer's supplier, is more likely to be looked at and has more transactions riding on certificates it may not have. The exposure and the attention scale together. But there is one other detail that catches sellers who have their certificate collection completely under control. Every certificate a business collects from customers has a mirror image, which is the certificates it should be giving to its own vendors. For example, inventory bought for resale or materials consumed in manufacturing are purchases that qualify for exemption too. When a vendor has no certificate on file, the vendor charges full tax correctly from their side, which means the same missing document that creates an assessment in one direction creates an overpayment in the other. And unlike the assessment, nobody sends a notice about it. And if you feel like you've overpaid sales tax, you definitely need to check out this video. And remember, when in doubt, always consult with a sales tax professional.